Okay, hi, I'm Joe and Judith. Hope you're both well. So I'm recording. I mean, I probably won't record that many. It'd probably be only because I think I've always thought of tax as a very live subject, as something we both all just kind of talk a bit of theory and bank some questions, talk a bit of theory, bank some questions, and see the application. But because of course of this whole Christmas period, I'm doing chapter 3 and 4, and my aim is to record the theory. I might do one or two questions, but really the aim is for you to really have a go at the questions, right? So that you can just at least say you've done the theory, and then you can bang into some questions. We started chapter 3, but it's important I go over it again because we didn't finish. So it's important I start it from scratch. So really, we moved on from non-savings income, if you remember, in our last class, to talk about to sort of say, well, listen, an individual is taxed on all their income, and we moved on from non-savings income to start talking about savings income, and savings income, a lot has changed when it comes to savings income over the years. Um, I believe even the chapter on ISAs are the section on ISAs are in this chapter, and they played a major role when it came to tax planning with savings income. But now, as we will see, the nil rate, there's certain nil rate bans for savings that somewhat take away the good work, if you like, that ISAs were meant to do. So let's jump into it. So when we talk about savings income, we're really talking, I mean, fundamentally, the truth is savings income is very much about interest. Of course, there are other things that I'll talk about, but really it's about interest on and interest from bonds, um, interest income, if you like, interest income. Now, unique to England, to the UK, there have always been these former post office accounts, and important to see here that these are investment accounts. So the post office used to do a range of products, certificates where you just got this income from NIS and I certificates, and these were always exempt. So if you had the certificate, almost like a gilt, I imagine, basic bond that the government just allowed you to keep for yourself. But this one, if you see NS and I investments, investment accounts, then the interest on there is liable to tax. And of course, gilts as well, government bonds. So any government bonds of any sort, liable to tax as well. And of course, um, of course, I think I highlighted last week that the loan stock itself, of course, it's an asset and it can increase in value, and you will be exempt from the capital gain on its sale, but the interest itself is liable to tax. So any interest on any quoted loan stock. So for example, if you lend money to Tesco's, or if you buy a debenture from Asda or Apple, or something along those lines, of course, to encourage people to invest in the stock market and to buy either shares or um, loan or notes, if you like. Okay, great stuff. So I started discussing this story here of dealing with the starting rate, and I said specific just to the savings income. There was this idea of a starting rate, not the nil rate band. We will see those, but these are the savings income nil. In addition, so the potential to enjoy the starting rate band was really due to the fact that you didn't have a lot of non-savings income in the first place. So it meant that you had a situation where you didn't have enough non-savings income, or you didn't have a lot. And we'll see the scenarios where you only had not a lot of taxable income, and as a result, you were able to enjoy. Or the argument was that the first 5,000 of that taxable income could enjoy a starting rate of 0%. But the point is, if for example, there was only 3,000 left of that taxable income available, that's all you can get. It has to fall into that band. On top of that, if you are a basic rate taxpayer, so this is based on your taxable income, we will be able to work that to see whether you're a basic rate taxpayer, higher rate taxpayer, blah, 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 blah. You will then get another £1,000 on your savings income, The first 1,000 of your savings income will be free to you. If you're a higher rate taxpayer, the first 500 will be free to you. And these are the bands. You have a basic rate band of 20% here on the first 37,500. So any income is treated in slices. Any income once you've dealt with the non-savings, anything left, the first in that will be treated at 20%. Of course, if you are a basic rate taxpayer, you would get the first 1,000 of that off, so it will be whatever is left that will be taxed at that 20%. And the same applies here, 40% and 45%. So this is sort of the little table you need to have. I think this is in the, it says this is in the tables, but it's something I imagine that you will come to know and work with regularly. Right, so the procedure, of course, generally, like I said, is to calculate income tax on non-savings income first. That's really the first place to go. We deal with that. And then we start looking to see how much, if there are any gaps, spaces left for us to enjoy, any gaps for us to enjoy some starting rate if we haven't been able to use it all up with our non savings income. Okay, so let's carry on. So I talked about this starting rate. Of course, we'll have to see an example to really see how this works. But again, I highlight this as it is not often that you will catch this. These are fairly limited. It's just that this software doesn't allow me to write on it. Fairly limited situations the way we can use this 5,000, and it's a 0%. It's tax free. And of course, it's whatever's left. Like I said, if there is some, again. And then, of course, if there's nothing left, then there's nothing left. And then we get this 100 and 500 will be talked about. And then, of course, the normal rates of 20, 40, and 45 apply, as with non-savings income. So it's about getting that columnar approach done. It doesn't matter whether you put the total. For some weird reason, I've always been more comfortable personally, it doesn't matter, with putting my total at the end. It doesn't really matter. As long as you have non-savings, savings, and dividends. And I think it's really important to do it like this. I haven't seen any material, even when I look at the answers, they look like this. I think it's the best way to do it. And to just deal with the non-savings first, because that also means you deal with it methodically. You're less likely to err with the use of the personal allowance. Okay, right. And again, we've talked about the fact that this is the order: non-savings, savings, and dividends. So you have a couple of examples here. I will probably do one as part of the exercise, but I don't want the videos to be too long. Maybe keep them short at 10 minutes to 11 minutes or something. So it says here, Jane receives bank interest in addition to what's going on here. And that's her employment income. That's her employment income. Remember, that's just employment income. We still have to take away her personal allowances to get her taxable income and see if there are no other reliefs. So looking at her scenario here, we have a scenario where her employment income is 11, and really we should have non-savings 11, savings 3. So nice two things, and then have total columns for this. And you can see straight away that her total income, of course, is 14,000. Well, that's 11 and 11. We have personal allowance of 12,500. Well, she has all of her, she's not, she won't, her and non-savings income doesn't totally wipe out the personal allowance, but it's okay. She has savings income, which we can. Remember, we can use personal allowance first against non-savings and then against savings. So she uses the 11 first against against non-savings, and she uses the rest of that 12,500 against savings. And there's 1,500 left of taxable income. But thankfully, all this taxable income is within the first 5,000. There's no non-savings income when we start wanting to tax. So this is susceptible, or is allowable, is sitting in that band of first 5,000 at 0% in terms of taxation. And so there's nothing to pay, no tax to pay. The 15,200, let's look at it here. Yes, I think you should always, this is important, I think I might have mentioned it before, even though it's a 0%, you want to show the examiner that it's a starting rate. If it was a written question anyway, just indicate it will be a section C for you to be able to signal to the examiner that you're fully aware that that's the starting rate. Okay, great. And let's do this one quickly before we take a short breather. Then we have 15,000 here, non-savings again, and 3,000 here. Apply exactly the same principle. We apply the personal allowance. We knock off. We now realize we have taxable income of 2,700. Non-savings income of 2,700 and savings of 3. Now we notice that the first 5,000 will be consumed by 2,700 will take up the first space of that 5,000. You'll have 2,300 left of starting income. starting rate income. So 2,300 of that can be used if you like here, but you will also have, of course, of this another 700, but she is a basic rate taxpayer, and so she will have the first 1,000 available, so that 700 can get taxed at 0%. So in a way, she's not paying any tax. So this is what I was saying. For you, the ISAs used to, we didn't have these benefits a long time ago, but this has ensured that people are not, if you like, paying a lot of tax anyway. So that's that, and that's how we deal with that bit. And so you can see she's only really paying tax on her non-savings income. And then finally, this was a slightly larger here. You have 20 employment income of 29 grand, and what we now have is employment income, bank interest, take off the personal allowance here, 16,500. All of this consumes there's no potential for starting rate. So that's just what it is. But it means that she is a basic rate taxpayer, so she will get the first 1,000 of this free. And then the rest she still, and we will have to check to see whether she still falls in the band. Of course she does. If the band is 0 to 37,500, she still falls in that band, so that will still be taxed at 20%. And you can see it gets added up. So this doesn't, you need to, the band, the 1,000 just sits as part of the band. So this 2,000 is within the rest of the band. And you now have that at 3,700. Cool, great stuff. So a couple of illustrations here, but to be fair, pretty much the same sort of principle. I think it's about making sure you get your order right, and you will be fine as long as you get your order right with tackling this. This, I will just look at this one just because here we have an additional, a higher rate taxpayer, which I think is important to just observe. So there's no question about a starting rate. There's nothing along those lines. So we now have non-savings and savings. And what we see again here is we take off the personal allowance as usual, and we now have this 40,500. So we can see here that as far as my bands are concerned, all of this, the 37,500 gets taxed at 20%, and the rest of this, the 3,000, because these two things together make up the 40, get taxed. So this person will be paying savings rate at 40%, but of course they only get the first 500 off free, and then the balance gets taxed at 40%. That really is the point. Ultimately, and here you have a much larger, a bigger scenario where you have 145 here. Don't forget, we talked about how when you're earning this type of income, you need to look for the adjusted net income to see if there's any gift aid and any pensions gross up being paid, nothing. So therefore, they lose all personal allowance, and therefore, additional rate payers don't get any. They don't get any nil rate band at all. So it's just bang all the way, just big, large taxations. You probably want to be advising your client to think of some ways to ameliorate this problem. Great stuff. Okay, good. So yes, that's 30 minutes. I'll see you in the next video.